Imagine earning money every single month without having to work overtime. Sounds too good to be true? Well, it's not. Today, we're diving into the top 4 investments that can help you generate monthly income. We're talking about building a portfolio that works as hard as you do, putting cash in your pocket without lifting a finger. Whether you're dreaming of early retirement, paying off debt faster, or just want a little extra cushion each month, these investment strategies can help you get there. Stay tuned as we break down each option, exploring the ins and outs, the risks and rewards, and most importantly, how you can get started on your journey to financial freedom. Let's get right into it. First up, we're talking about dividend stocks. Now, if you're thinking stocks are just for Wall Street hotshots, think again. Dividend stocks are like the friendly giants of the stock market. They're established companies with a proven track record of success, and they like to share the wealth with their investors. That's you. So how does it work? When you buy a dividend stock, you're essentially buying a tiny piece of that company. As a shareholder, you're entitled to a portion of their profits, which they distribute in the form of dividends. These dividends are usually paid out quarterly, but some companies even pay them monthly. Think of it like getting paid to wait. You invest in a solid company, and they reward your loyalty with regular cash payments. It's like having a side hustle that earns you money while you sleep. Now, you might be wondering, what kind of companies are we talking about? Well, some of the biggest names out there are known for their consistent dividend payments. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble have been paying dividends for decades. They've weathered economic storms and market crashes, yet they still keep those dividend checks coming. But hold on, before you go all in on any stock, remember, diversification is key. Don't put all your eggs in one basket. Instead, spread your investments across different industries and sectors. That way, if one industry takes a hit, your entire portfolio won't go down with it. Now let's talk about how to spot a good dividend stock. First and foremost, look for companies with a strong history of dividend payments. You want to see a consistent track record of paying dividends, ideally increasing them over time. This shows that the company is committed to rewarding its shareholders. Next, check out the company's financial health. Look at their earnings, revenue growth, and debt levels. You want to make sure the company is in good financial shape and can sustain those dividend payments in the long run. Remember, investing in dividend stocks is a marathon, not a sprint. It's about building a portfolio of solid companies that will generate passive income for years to come. So do your research, be patient, and watch your money grow. Next up, let's talk about real estate investment trusts, or REITs for short. Now, I know what you're thinking. Real estate, isn't that for landlords and property moguls? Not anymore. REITs let you tap into the lucrative world of real estate without the headaches of being a landlord. Think of REITs like baskets of real estate properties. These baskets can hold anything from apartment buildings and shopping malls to office spaces and data centers. When you invest in a REIT, you're essentially buying a piece of all the properties in that basket. But here's the best part. REITs are legally required to distribute a significant portion of their taxable income to shareholders as dividends. That's right, those juicy rental payments and property appreciation can land directly in your pocket, all without you having to fix a leaky faucet or deal with difficult tenants. Now let's talk about why REITs are such a powerful investment tool. First off, they offer incredible liquidity. Unlike physical real estate, which can take months or even years to sell, you can buy and sell REITs on the stock market just like any other stock. This makes them a much more flexible investment option. Secondly, REITs give you the opportunity to diversify your portfolio without breaking the bank. Imagine trying to buy a shopping mall or an office building on your own. It would cost a fortune. But with REITs, you can invest in a diversified portfolio of properties with a relatively small amount of money. Now, before you jump into the world of REITs, it's crucial to do your homework. Just like with any investment, there are risks involved. The real estate market can be cyclical, meaning prices go up and down. When choosing a REIT, look closely at the types of properties they hold. Are they invested in apartments, commercial real estate, or something else? Consider your investment goals and risk tolerance. Do your research, compare different REITs, and choose the ones that align with your financial objectives. Chapter 3: Bonds, the steady eddy of monthly income. Let's move on to our third investment strategy for monthly income bonds. Now, Bonds might not have the same flash and excitement as stocks or real estate, but they play a crucial role in any well-rounded investment portfolio. Think of bonds as the steady eddy of the investment world. They're not here to make you rich quick, but they offer something much more valuable: stability and predictable income. So what exactly are bonds? In simple terms, a bond is like a loan that you give to a company or government. When you buy a bond, you're essentially lending money to the issuer for a fixed period. In return, the issuer promises to pay you regular interest payments, known as coupon payments, and to repay the principal amount of the loan when the bond matures. Now, there are different types of bonds out there, each with its own risk and reward profile. You've got corporate bonds issued by companies, municipal bonds issued by state and local governments, and treasury bonds issued by the US government. Corporate bonds generally offer higher interest rates than government bonds because they carry more risk. After all, companies can go bankrupt, whereas governments are less likely to default on their debts. On the other hand, government bonds, especially US Treasury bonds, are considered among the safest investments in the world. Now, here's how bonds can generate that sweet, sweet monthly income. Many bonds pay interest semi-annually, meaning you get 2 payments per year. However, some bonds, known as monthly pay bonds, do exactly what their name suggests. They pay interest every single month. Before you dive headfirst into the world of bonds, remember, just like any investment, it's crucial to do your research and understand the risks involved. One of the key factors to consider is credit quality. Credit rating agencies like Standard & Poor's and Moody's assign ratings to bonds based on the issuer's financial strength and their ability to repay their debts. Bonds with higher credit ratings are considered safer investments, while bonds with lower ratings carry a higher risk of default. Generally, the higher the credit rating, the lower the interest rate, and vice versa. Chapter 4: Peer-to-Peer Lending. Be the bank, reap the rewards. Finally, let's talk about a more unconventional investment strategy for monthly income: peer-to-peer lending, or P2P lending for short. Now, P2P lending might sound a little intimidating at first, but it's actually a pretty straightforward concept. Imagine cutting out the middleman, the big banks, and lending money directly to individuals or small businesses. That's the essence of P2P lending. It's like becoming your own bank, connecting borrowers with lenders directly through online platforms. These platforms act as intermediaries, facilitating the entire lending process, from loan applications and credit checks to interest rate calculations and payment processing. They take a small fee for their services, but the bulk of the interest payments goes directly to you, the lender. Now, you might be wondering, why would I lend my hard-earned money to strangers? Well, the answer is simple. Returns, my friend, returns. P2P lending can potentially offer higher interest rates than traditional savings accounts or bonds. Think about it. When you deposit money in a savings account, the bank lends that money out to borrowers at a higher interest rate, pocketing the difference as profit. With P2P lending, you get to be the bank, earning a larger share of the interest income. Of course, higher potential returns often come with higher risks. One of the biggest risks in P2P lending is the possibility of borrowers defaulting on their loans. That's why it's crucial to diversify your investments across multiple loans, just like you would diversify your stock portfolio. Instead of putting all your eggs in one basket, spread your investments across a variety of borrowers with different credit profiles and loan purposes. This way, if one borrower defaults, it won't significantly impact your overall returns. Another crucial aspect of successful P2P lending is thorough research and due diligence. Before you lend money to anyone, take the time to understand their credit history, their debt-to-income ratio, and the purpose of the loan. Your monthly income journey starts now. So there you have it, our top 4 investment strategies for generating monthly income. We've covered dividend stocks, those reliable income generators from the stock market; REITs, your gateway to real estate without the hassle; bonds, the steady eddies of the investment world; and P2P lending, where you can become the bank and potentially earn higher returns. Now, before you rush out and start investing, remember, the best investment strategy for you depends on your individual financial situation, risk tolerance, and investment goals. What works for one person might not work for another. It's crucial to do your research, understand the risks involved, and if needed, consult with a financial advisor to create a personalized investment plan. If you found this video helpful, give it a thumbs up and share it with anyone looking to boost their income. Don't forget to subscribe for more content on smart investing and financial growth.